Imagine a balloon. It's a simple everyday object, but it can help us understand a complex economic concept. You blow air into it, and with each breath, it grows larger and it gets bigger and bigger, stretching its limits. That's kind of like an economic bubble. In the financial world, it happens when the prices of assets like houses or stocks rise rapidly. Prices of things like houses or stocks go up faster than their real value. This rapid increase is often driven by speculation. People get excited and buy more, hoping to get rich quick. They believe the prices will keep going up. This pushes prices even higher, but it's like blowing more and more air into the balloon. The experiment and optimism keep inflating the bubble. Eventually, it can't hold anymore. The balloon reaches its limit, and so does the market. When the balloon crashes, prices crash. The sudden drop can be dramatic, and people lose their money, sometimes a lot of it. The financial losses can be severe, affecting many individuals and families. It can hurt the whole economy. Businesses may close, jobs can be lost, and the overall economic health can decline. How can we tell if we are in a bubble? Detecting a bubble isn't straightforward, but there are clues. It's not always easy, and there are some warning signs. Analysts look for rapid price increases, high trading volumes, and excessive optimism in the market. Bubbles often start with something new and exciting, like a new technology or a period of economic growth. The initial spark can create a sense of optimism and opportunity, drawing in investors and consumers alike. People start to believe that this new opportunity trend will lead to endless prosperity. This can lead to irrational exuberance, meaning people get caught and make risky decisions. Investors driven by the fear of missing out pour their money into the new opportunities without fully understanding the risks involved. The excitement can be contagious, spreading quickly through the markets and communities. Low interest rates can also fuel a bubble. When borrowing is cheap, it encourages people to take on more debt to invest in assets that they believe will continue to rise in value. This easy access to credit can inflate prices even further, creating a cycle of increasing demand and rising prices. When it's cheap to borrow money, people are more likely to invest in things like property or stocks, driving up demand and prices. This surge in investment can create a sense of urgency as people rush to buy before prices go even higher. The market becomes saturated, each one pushing prices up further. As prices rise, more and more people jump on the bandwagon, afraid of missing out. The fear of missing out, or FOMO, can drive even the most cautious investors to take risks they normally wouldn't consider. This frenzy builds with everyone trying to take action before it's too late. This is called herd behavior. People follow the crowd, assuming that if everyone else is investing, it must be a good idea. The collective movement can create a powerful force driving markets to unsustainable heights. The belief that the trend will continue indefinitely blinds people to the underlying risks. But at some point, reality sets in. The bubble bursts and the prices plummet. Those who bought at the market initial peak themselves facing significant losses. The euphoria turns into a panic and the market correction. The aftermath leaves a trail of financial ruin and shattered dreams. Remember the 2008 financial crisis? That was a prime example of a bubble bursting. Easy credit and relaxed lending standards led to a surge in housing prices. People thought they could make a quick profit by flipping houses. Banks even created complex financial products based on these mortgages. When the bubble burst, millions of people lost their homes. Banks collapsed and the world plunged into a recession. The 2008 crisis was a painful reminder that what goes up must come down. It also highlighted the importance of regulation and responsible lending practices. The economic landscape of 2025, a bubble in the making. As we look forward, the economic landscape is filled with both opportunities and uncertainties. The question on everyone's mind is whether we are heading towards a financial bubble. Fast forward to 2025, the world has changed dramatically, with technology and innovation driving new growth. Cities have transformed and the pace of life has accelerated. The global economy is still recovering from the pandemic and the inflation is a concern. Supply chain disruptions and labor shortages have added to the complexity, making it difficult for businesses to predict future trends. Interest rates are rising as central banks try to control inflation. This has led to increased borrowing costs, affecting both consumers and businesses. The financial markets are reacting with caution. Some experts worry that certain asset classes like tech stocks or digital currencies might be overvalued. The rapid rise in prices has sparked fears of a potential market correction. However, others argue that the current situation is different from the 2008. They believe that the underlying fundamentals are stronger and that the market has learned from past mistakes. They point to strong corporate earnings and a robust job market as signs of a healthy economy. Companies are reporting record profits and unemployment rates are at historic lows. So, are we in a bubble? The debate continues. With opinions divided, only time will tell if the current economic trends will lead to sustained growth or a financial downturn. Navigating the uncertain terrain ahead. The truth is, it's too early to say for sure. Economic bubbles are complex phenomena and there's no crystal ball to predict the future. However, by understanding the causes and consequences of bubbles, we can be better prepared to navigate the uncertain terrain ahead. It's important to be cautious and avoid getting caught up in the hype. Don't invest more than you can afford to lose, and remember that what goes up can come down, sometimes very quickly. Are bubbles inevitable in a fast paced economy like 2025? Please comment. Thanks for watching.